Welcome to another episode of Quest for Twice. Today is August 9th. Most of the companies in my portfolio have reported their latest earnings. So in this episode, I'm going to cover several of them. The first one is INMD. As I mentioned about 3 months ago, its quarter one revenue was impacted by pandemic in Asia and also upgrade cycle of a new hands-free equipment. So in Q2 of this year, its revenue rebounded to $213 million, and that's a historical high, significantly higher than $87 million 1 year ago. So its sequential growth has resumed. The company also updated its full year sales guidance to $430 million from $420 million guidance 3 months ago. So if we look at its revenue history since 2016, that's about 50% CAGR and 20% growth over last year. Just keep in mind that last year's revenue was artificially high because of pandemic impact on the revenue in 2020. In this year, the stock price has declined significantly from almost $100 at the beginning of the year to over $30 recently. However, its trailing 12-month revenue has continued its growth. So now its price over sales is a little over 6. Its forward PE is about 15.6, and that's low for a high growth company. ATKR also reported a very strong quarter. Its fiscal Q3 revenue came in around $1.06 billion compared to $854 million 1 year ago. And also its margins stay high. The electrical segment margin is almost 43%. That's close to historical high. And its mechanical segment margin is almost 19%. That's significantly higher than previous quarters. Both segment revenues were at a historical high. So as a result, its Q3 EBITDA was $378 million compared to $360 million in previous quarter and $293 million in the first fiscal quarter of this year. However, the management gave a very cautious outlook. It didn't change its fiscal Q4 revenue and EBITDA forecast at about $315 million. The management also reaffirmed its fiscal 2023 EBITDA outlook between $800 and $900 million, and reiterated that the market price and margin will normalize, but the timing is uncertain. The management did mention the lead time and the inventory is normalizing, which usually will lead to normalizing in price. So as a result, the ATKR's stock price actually declined following its very strong Q3 earnings report. ATKR continued its strong and wise capital deployment in this fiscal year, spent $82 million of capex, including purchase land to build another regional distribution center near Dallas, Texas. Spent about $250 million for acquisitions and almost $500 million to buy back shares. The management has a very strong track record of deploying capital for smart acquisitions. So I'm happy with how the management has been spending capital in this year. Looking at the valuations, its enterprise value is about $4.3 billion at $89 per share. So its EV over EBITDA is about 7.2 if we use $150 million of quarterly EBITDA. So its valuation is significantly less than Hubble and Emerson. So I believe its stock price is still undervalued, and my original investment case is still valid. Energy Transfer also reported its quarterly earning and raised its full year EBITDA to about $12.7 billion. That's $300 million more than its previous guidance because of a very strong commodity environment. It reduces its net debt. So as a result, I believe its DCF in 2022 will come in around $8.2 billion. Its full year capital budget stays the same, around $2 billion, and the company raised its forward dividend distribution to about $2.84 billion per year. So adding the capital and the dividend together, that's about $4.8 billion. That's significantly less than the full year DCF, about $8.2 billion. Management stated its intention to continue its forward dividend distribution hike. So I think there is plenty of firepower for the management to do that. There will also be money left to buy back shares, which I think is a better use of capital. Regardless, I think the current stock price at about $10.80 is undervalued. I'm happy to be a shareholder of Energy Transfer. Amazon.com also delivered a strong quarter. Its sales came in around 7%. That's better than the 5% guidance it gave about 3 months ago. Its guidance for the Q3 is for sales to grow 15% despite the foreign exchange impact. That's actually a very strong guidance. Looks like it's ready to accelerate its growth again. AWS grew 33%. That's a deceleration from 37% in the Q1 of this year, comparing to Microsoft Azure of 46% and Google Cloud of 36%. So given AWS is much larger, so 33% is still very high growth. And also, encouragingly, it seems its e-commerce segment has stabilized. If we look at this year-on-year growth plotted for the last 8 or 9 quarters, except its online store, it's still contracting. Most of other segments are showing upward trend or stabilizing trend. What is also encouraging is Amazon's margins also improved. As I mentioned in previous review after its Q1 earning update, Amazon.com faced cost pressure from inflation of energy and shipping, overcapacity in labor and fulfillment center and distributions. And Amazon's management had a plan to digest and reduce those costs. So if we look at the latest cost of goods sold, the unit cost reduced from 57% to about 55%. Its unit fulfillment cost also reduced from about 17.5% to less than 17%. So good progress with improving the profit margins. So at the current EV over gross income, the ratio is about 7.2 at $141 per share. That's the lowest valuation since 2015. Given there is still long way ahead for cloud infrastructure as well as e-commerce, the current Amazon.com's stock price is attractive in my opinion. On the other hand, Meta Platforms, aka Facebook, reported a disappointing earning. its Q2 sales was basically flat from 1 year ago. If we exclude the foreign exchange impact, it's about up 3%. That's still less than Q1 sales growth of 7%. More importantly, the management gave a Q3 sales outlook to a decline about 10 to 2% from 1 year ago. As I mentioned before, it's because the strong competition from TikTok and the Reels it's hard to monetize at a lower monetization value, as well as a broad economic slowdown and the impact on the advertisement market. A silver lining in its earning report is its overall user growth. So its daily active users grew less than 1% from the last quarter. However, the Facebook average revenue per user is actually less in Q2 of this year compared to Q2 last year. This year, it was about $9.82 compared to $10.12 1 year ago. That's mostly because of the reduction in US, Canada, and Europe. In Asia Pacific and the rest of the world, its average revenue per user grew by about 10%. The Europe number may be affected by foreign exchange rate. However, it is concerning that in the US, the average revenue per user of $50.25 is about 6% less than 1 year ago. That's likely because of the reduced demand for advertisement, as well as stronger competition from TikTok, as I mentioned before. I would argue at the current stock price of 167 per share, the bad news has been reflected adequately. The EV over EBITDA now is less than 9, and the forward PE is about 16. More importantly, its cash flow yield is over 12%, despite the heavy investment in R&D and the metaverse. So the market is forecasting negative growth and is ignoring opportunities in the revenue growth outside US, Canada, and Europe, as well as opportunities in monetization of WhatsApp and the metaverse in the future. So despite the bad news, I think metaverse platform's stock price is undervalued. However, if I look at the original investment thesis, it's questionable that the metaverse platforms can ever return to growth, because that depends on how well its Reels short-form video platform will be able to compete with TikTok, as well as the future development in metaverse. Since its user growth is either flat or just very slowly, then it becomes very sensitive to broad economy slowdown. That's an additional threat I would like to document here. This concludes this episode of Quest for Twice. Until next time, happy investing.